In a move that stunned both Wall Street and Main Street, Hyundai is pulling out of the US market, immediately and completely. The South Korean automaker, long a symbol of value and reliability for millions of Americans, is leaving as a direct result of the Trump administration's aggressive new America First automotive policy. The news has triggered panic in the stock market and left industry analysts scrambling to predict the fallout. Hyundai's exit isn't just a business story. It's a seismic shift for the American economy and its workers. For decades, Hyundai invested billions, built factories, and created tens of thousands of American jobs. Now, that all comes to a screeching halt. This moment raises urgent questions about the future of American manufacturing, the stability of global trade, and the real cost of political promises. As we dive into this breaking story, we'll explore the policy that triggered the crisis, the history behind it, and the devastating impact on American communities. The rules of the game have changed, and the aftershocks will be felt by everyone. America's uneasy relationship with foreign automakers stretches back decades. In the 1970s, the oil crisis opened the door for Japanese brands like Toyota and Honda, whose fuel-efficient cars quickly gained ground as gas prices soared. This sparked the first wave of protectionism quotas on Japanese imports, intended to help Detroit. Instead, pushed Japanese brands upmarket and made them even more entrenched. The 1964 chicken tax, a 25% tariff on imported trucks, forced foreign automakers to build plants in the US, shaping the industry for generations. These policies show a pattern: foreign competition rises, American industry feels threatened, and Washington responds with trade barriers. But the results are rarely simple. Tariffs often backfire, creating both winners and losers. The current administration's policy is just the latest and perhaps most dramatic chapter in this long saga. History warns us, simple solutions in a global industry rarely deliver simple results. Today's crisis is rooted in decades of complex, often unpredictable policy decisions. The stakes have never been higher. The trigger for Hyundai's exit is the Automotive Fair Share Act, a centerpiece of President Trump's second-term agenda. The law slaps a 30% tariff on all imported vehicles and requires any car built in the US by a foreign company to have 75% North American-made parts or face a 15% penalty tax. The administration claims this will bring jobs back to American soil, but the timeline is brutally short. Automakers have just months to comply. For Hyundai, the math didn't add up. Imports would be hit with massive tariffs, and even US-built models couldn't meet the new parts threshold in time. The company faced a choice: overhaul its entire supply chain at enormous cost, absorb billions in losses, or leave. Hyundai's leadership saw the policy as hostile and unpredictable and chose to withdraw entirely. The America First tariff, meant to force investment, instead triggered a total retreat. The consequences are immediate and far-reaching. Hyundai's announcement was swift and final, a phased but total withdrawal from the US market, citing the Automotive Fair Share Act as the sole reason. All new vehicle shipments stop by October 31, 2025. All sales and manufacturing wind down by mid-2026. CEO Jae-hoon Chang expressed regret, but said the new tariffs made sustainable business impossible. Hyundai invested over $10 billion in the US, built a flagship plant in Alabama, and supported over 40,000 jobs nationwide. Now all of that is on the chopping block. Dealerships will sell off existing inventory, but no new models are coming. The Alabama plant will cease production by March 2026. Hyundai promises to honor warranties and provide service through third parties, but details are unclear. For millions of Americans, the brand they trusted is vanishing overnight. The economic shock will hit Alabama first, where Hyundai's plant anchors a vast network of suppliers and small businesses. The closure will trigger thousands of job losses and could plunge the region into recession. Nationally, removing a top 5 automaker means fewer cars, higher prices, and less choice, especially for affordable sedans and SUVs. The policy's goal was to boost American manufacturing, but instead, it's destroyed jobs and sent a chilling message to foreign investors. Internationally, the fallout is just beginning. South Korea, a key US ally, has already protested and is considering retaliatory tariffs. Rather than isolating rivals, the policy risks alienating America's friends and destabilizing global trade. The shockwaves are spreading from local economies to international relations. The cost of this policy is growing by the day. The human cost is staggering, especially in Montgomery, Alabama, where Hyundai jobs meant stability and a path to the middle class. Now, thousands face unemployment in a region with few alternatives. For car buyers, the loss of Hyundai and likely Kia means fewer affordable options and higher prices. Families shopping for a reliable new car under $25,000 will find their choices shrinking or gone. Small business owners running Hyundai dealerships face financial ruin, with their investments and livelihoods wiped out. These dealerships, often family-run, are pillars of their communities, now facing extinction. Millions of Hyundai owners are left in limbo, unsure where to get service or how much their cars are now worth. The value of their vehicles will plummet, and the logistics of warranty support are uncertain. This isn't just about numbers, it's about lost jobs, failed businesses, and diminished family assets. The ripple effects will be felt for years. To understand the bigger picture, we spoke with Dr. Emily Carter, a global trade expert at the Peterson Institute. She says the America First tariff was based on a flawed assumption that global companies would simply comply, ignoring their other options. Hyundai, she explains, chose to walk away rather than submit to unpredictable, punitive policies. This is classic capital flight. Companies need stability to invest, and sudden radical changes make the US look unreliable. The result? A net loss of jobs, not gains. Tens of thousands of high-paying positions vanish overnight, with no guarantee domestic automakers will fill the gap. Building new plants takes years. The job deficit is immediate and massive. Dr. Carter warns this could be just the beginning. Other foreign automakers are watching and reassessing their own risk. Will they double down on US investment or quietly reduce their exposure? The intended message of strength may have signaled instability instead. The chilling effect on foreign investment could spread far beyond the auto industry. America's reputation as a stable place to do business is now in question. Hyundai's exit is just the first domino. Kia, its sister company, faces the same pressures and is expected to follow. That would double the damage, closing another major plant and removing another affordable brand. Japanese and European automakers are now scrambling to review their supply chains and decide whether to localize or risk penalties. The cost of doing business in America has just skyrocketed for everyone. US automakers may benefit in the short term, but a less competitive market could mean higher prices and slower innovation. Retaliatory tariffs from allies could hurt American companies too. The biggest setback may be for electric vehicles. Hyundai and Kia were leaders in affordable EVs, and their departure leaves a major gap. This could slow EV adoption and make climate goals harder to reach. The road ahead for the auto industry is uncertain and fraught with risk. The ripple effects will reshape the market for years to come. Hyundai's stunning exit marks a turning point for America's economy and its global reputation. A policy meant to protect American jobs has instead destroyed them, dismantled billions in investment, and sent a message of instability worldwide. The empty factories and shuttered dealerships are a stark warning about the unintended consequences of aggressive protectionism. The crisis will trigger regional downturns, reduce consumer choice, and strain relationships with key allies. The choices made now will determine if this is a one-off disaster or the start of a broader unraveling. It's time for leaders to look past rhetoric and confront the real-world impact of these policies. The lesson is clear: building walls in a global economy can leave everyone worse off. America must find a smarter path forward, one that protects jobs without sacrificing its future.